I've lived through 14 recessions, and I'll likely see one or two more. Economies cycle, boom to bust, expansion to contraction, like the tides. You can't stop them, but you can prepare. The goal, not just survive the next downturn, but thrive in it. Most people view recessions as threats and hunker down. I've learned the opposite over 75 years of investing. Recessions are when fortunes are built. Take 2008. Markets crashed, banks failed, homes were foreclosed, fear was everywhere. I wrote an op-ed titled, "Buy American, I Am," and invested billions in Goldman Sachs, General Electric, Dow Chemical, and Swiss Re while others fled. Those positions generated billions for Berkshire Hathaway, not because I'm smarter, but because I saw a fire sale on great businesses. Recessions are clearance events. When everything's 50 to 70% off, smart shoppers load up. Most investors panic sell instead. Recessions hurt real people. Jobs vanish, savings evaporate if unprepared. Preparation is everything. Here's my 15-step playbook, honed over decades.
1. Cash is king entering a recession. In bull markets, stay fully invested. Approaching downturns, hoard cash, dry powder to deploy when assets crater. Keep 6+ months of expenses liquid. Maintain a separate investment reserve. Berkshire's billion-dollar cash pile drew criticism until 2008 proved its value. 2. Build your shopping list now. Emotions spike in crises. Pre-select 10 to 20 high-quality companies, strong moats, robust balance sheets, enduring demand. Study them deeply. In 1963's salad oil scandal, I loaded 40% of my partnership into American Express at rock-bottom prices. It multiplied many times over decades. 3. Master the psychology. Train to be greedy when others are fearful. Ignore headlines. Trust your homework. Mental rehearsal builds discipline to act amid panic. 4. Never use leverage. Borrowing amplifies gains in up markets, but triggers forced sales at bottoms. Long-term capital management's 1998 collapse, despite Nobel laureates, shows leverage's peril. Invest only capital you won't need for 5+ years. 5. Diversify intelligently. Own 10 to 15 understandable businesses across sectors, like banks, consumer staples, utility, or railroad. Overweight defensives pre-recession. Rotate into cyclicals when cheap. In 2008, Procter & Gamble, Johnson & Johnson, and Coca-Cola provided stable cash flow, freeing me to buy beaten-down names. 6. Scrutinize balance sheets. Debt-laden firms fail in downturns. Favor low-debt, high-cash companies that survive 30% revenue drops. In 2008, J.P. Morgan's conservatism made it a winner. Weaker banks like Wachovia vanished. 7. Think in decades. Recessions are blips in America's 200-year growth arc. Treat stocks as fractional farm ownership. Droughts pass, value endures. I bought Coca-Cola in 1988 and held through multiple crashes. Ben Graham said, "The market is a voting machine short-term, weighing machine long-term." 8. Live below your means, always. I've occupied the same modest Omaha home since 1958. Avoid lifestyle inflation. Bank raises? Don't spend them. High earners with zero savings crumble in layoffs. Save aggressively for unbreakable security. 9. Stay informed. Ignore the noise. Media thrives on fear. Check headlines daily, but focus on fundamentals. I tuned out dot-com mania in 2000. Bubble stocks later fell 90% plus.
10. Distinguish price from value. A $10 million earner valued at $150 million in good times may trade at $60 million in panic. Same business, wider margin of safety. Recessions maximize this gap for value investors. 11. Plan your exit reinvestment strategy. Define goals up front. Retirement, education, independence. I hold great businesses forever. Others rebalance profits. Purpose beats gambling. 12. Don't time perfectly. Buy when markets drop 30 to 40% and fear peaks. Dollar cost average downward. Perfection paralysis misses the sale. 13. Study history. Patterns repeat across eras. Great Depression. Deflation favored cash. 1970s. Inflation crushed it. 2000 bubble. 2008 crisis. Core tenets hold. Quality, contrarianism, discipline. 14. Cultivate courage. Most freeze when blood's in the streets. Visualize crises repeatedly to desensitize fear and execute flawlessly. 15. Practice patience. Post-purchase volatility tests resolve. Plant acorns, investments, nurture. Wait years for oaks. Recoveries always arrive. Recessions are inevitable. Next year or in 5, who knows? Panic and regret, or prepare and prosper? At 95, my cycle nears its end. Yours has decades of opportunities ahead. Choose wisely. Warren Buffett's key investments during the 2008 financial crisis. In the rewritten article, based on Buffett's own words from interviews, letters, and his October 2008 New York Times op-ed, Buy American, I Am, he highlights buying Goldman Sachs, General Electric, Dow Chemical, and Swiss Re right in the middle of the crisis with billions of dollars while others panicked. These were preferred stock deals with warrants, not common stock purchases, giving Berkshire Hathaway downside protection, high dividends, plus upside potential. Here's a clear breakdown of each investment, why he made it, the terms, and the outcome. 1. Goldman Sachs, $5 billion, September 23, 2008. Context: Goldman was the strongest investment bank but faced a liquidity crisis as Lehman Brothers collapsed. Deal terms: $5 billion in perpetual preferred stock paying 10% dividend, $500 million per year. Warrants to buy $5 billion of common stock at $115 a share. Strike price. Why? Buffett saw Goldman as a survivor with a strong franchise. The 10% yield provided income even if stock stayed low. Outcome: Goldman redeemed the preferred in 2011 for $5.64 billion, plus $1.26 billion in fees or dividends. Exercised warrants in 2013 turned into $3.2 billion profit on common shares. Total gain around $3.7 billion. 2. General Electric, GE, $3 billion, October 1, 2008. Context: GE Capital, finance arm, was frozen out of credit markets. Stock plunged. Deal terms: $3 billion perpetual preferred at 10% dividend. Warrants to buy $3 billion common at $22.25 per share. Why? GE was an industrial icon with AAA credit, rare then. Buffett bet on survival, not speculation. Outcome: GE redeemed in 2011 for $3.3 billion plus dividends. Sold warrants gradually, around $500 million profit. Total gain around $1 billion. 3. Dow Chemical, $3 billion via Rocade Acquisition Financing 2009. Dow was acquiring Rome and Haas but needed cash after Kuwait pulled out. Deal terms: $3 billion in convertible preferred stock at 8.5%, later adjusted. Part of a larger financing package. Why? Buffett trusted Dow's chemical moat and management, saw temporary distress. Outcome: converted or redeemed over time. Solid return, though less publicized, around hundreds of millions. 4. Swiss Re. 3 billion Swiss francs, approximately 2.6 billion USD, February 2009. Context: world's second largest reinsurer hit by subprime losses. Deal terms: convertible bond paying 12% interest. Convertible into equity at a premium. Why? Reinsurance is a high-moat business. Swiss Re was undercapitalized but not insolvent. Outcome: converted in 2011, and Berkshire owned 3% of Swiss Re. Later sold stake, multi-billion gain over time. Key takeaways from Buffett's 2008 strategy. He didn't buy common stock at the bottom. He bought preferred securities with high yields and conversion rights. Cash was ready. Berkshire held $44 billion in cash pre-crisis. Focused on survivors, only companies with strong brands, balance sheets, and competitive moats. Contrarian timing. Acted when fear was maximum. The VIX hit 80 plus. Long-term hold. Even after redemption, he often kept or added common shares. Quote from his 2008 shareholder letter: "We simply look for opportunities where we can get more value than we pay for, and 2008 provided plenty."